There's not going to be a new currency to replace the dollar. I think the dollar is going to be replaced by gold. So I think gold is going to serve the role that the dollar had been serving as both a reserve asset for central banks and as settlement for bilateral trade. I think gold is going to play an increasingly important role in the global monetary system the way it was prior to the U.S. dollar supplanting it. And as the dollar goes down, I think that's going to create an economic boom outside the United States. A lot of dollar-denominated debt is going to be basically wiped out. And consumers outside the United States are going to find that they have a lot more purchasing power. So I think you're going to see, higher living standards abroad and lower living standards in the U.S. Yeah, but gold got almost to 5,600 before pulling back. I think that it will end the year above 6,000. We'll see how much higher, but I'm very confident that the high that we set earlier in January will be taken out probably before the end of the second quarter, because the debt is unsustainable. It can't be repaid. It can't even be serviced. So it's going to be either default or inflation. And obviously, politically expedient choice is inflation. And that's the direction that we're headed.
Pacific Asset Management to talk about what's happening in the world and how money is likely to move henceforth. Peter, great to have you on the show. Thank you for joining us. Let me start off with the entire thing with regard to the current gold rally, which you've been seeing. You've been bullish on gold for quite some time now. How do you see the rally panning out from here, barring, of course, that intermittent volatility that keeps cropping up?
Well,
Schiff frames dollar weakness not as temporary cyclical phenomenon, but as secular trend lasting many years to come. The key phrase fiat counterparts reveals his view. All fiat currencies are flawed, but dollar is weakest because of fiscal monetary recklessness. When dollar falls against euro, yen, franc simultaneously, it signals loss of relative advantage. Historically, dollar could be least worst fiat. Now it's becoming worst of the worst. The capital flow is mechanical. As dollar weakens, holders of treasuries suffer both currency loss, dollar depreciation, and potential principal loss, yields rising as buyers disappear. Gold becomes rational alternative. No currency risk, no counterparty risk, no political risk. The exodus from U.S. financial assets encompasses stocks, bonds, real estate. Everything dollar-denominated gets repriced lower in global purchasing power terms.
I think gold's going to continue to move higher, especially now that the U.S. dollar is moving lower against its fiat counterparts. In fact, I expect pronounced U.S. dollar weakness throughout the rest of this year and for many years to come. So all of that is going to drive more money out of U.S. dollars and U.S. financial assets like treasuries into gold and other non-U.S. dollar denominated investments.
Right. So, Peter, important to analyze how is it that you see the strength of dollar, because you've spoken about the fact that you're going to see dollar weaken this year. What would be the factors that will push the dollar low, according to you?
Well, I think it's going to be the continued loss of confidence in the fiscal responsibility of the U.S. government and the independence of the Fed. I think you're going to see ever increasing U.S. federal deficits monetized by the central bank. So the supply of dollars is going to increase substantially. In the meantime, I think the world wants to move away from the dollar. The U.S. has weaponized the dollar, first with Biden and now with Trump. I think the world is not looking kindly at the rhetoric and the tariffs, which are making it more difficult to trade with the United States. I think the world would be better off trading a lot less with the United States. And so I think there should be more trade outside the United States, and, countries that are major exporters should consume more of what they produce rather than subsidize American consumers so that we could buy it. So I think you're going to see a major shift out of dollars. I think foreign central banks will continue to move reserves to gold and out of dollars. I think global investors will keep pulling money out of U.S. financial markets.
This segment identifies 3 concurrent dollar death drivers. 1. Fiscal. Ever-increasing deficits with no political will to address them signal eventual default or monetization. 2. Monetary. Fed independence is collapsing. Trump pressures for rate cuts despite inflation, turning Fed into Treasury's printing press. Monetization of deficits. Fed buying treasuries government can't sell privately is classic Zimbabwe Weimar pathway. 3. Geopolitical. Dollar weaponization, sanctions, asset seizures, plus protectionist tariffs make trading with U.S. simultaneously risky, sanctions threat and expensive, tariffs. The world's logical response: trade more with each other, less with U.S. Exporters consuming their own production rather than subsidizing American consumers represents massive shift. For decades, China, Germany, Japan produced for U.S. consumption, accumulating dollars. Now they produce for domestic regional consumption, accumulating gold. This isn't anti-American spite, it's rational capital preservation.
And as the dollar goes down, I think that's going to create an economic boom outside the United States. A lot of dollar-denominated debt is going to be basically wiped out. And consumers outside the United States are going to find that they have a lot more purchasing power. So I think you're going to see, higher living standards abroad and lower living standards in the U.S.
This is the zero-sum reality of currency collapse. Purchasing power is finite globally. When dollar weakens, every other currency strengthens relatively, shifting consumption capacity from Americans to foreigners. The economic boom outside U.S. isn't new production, it's existing production being consumed by those who made it rather than exported to America. Dollar-denominated debt wiped out benefits foreign borrowers. Loans become cheaper to repay in local currency, while devastating U.S. creditors. The living standards divergence is mechanical. Americans currently consume 25% plus of global resources, with 4% of population because strong dollar. Weak dollar reverses this, foreign workers affording what they produce, Americans unable to afford imports. This isn't punitive, it's regression to mean. The boom-bust language captures psychological shock. Foreigners celebrate newfound wealth. Americans experience sudden poverty despite same nominal wages.
Peter, how do you see or how do you attribute the diversification of central bank reserves? We've seen a lot of central banks now adding gold to the reserves, and for many, gold reserves are more than US treasuries at this point in time.
Yeah, well, in the past, foreign central banks have accumulated dollars. I think that was a mistake. It benefited the United States, but it perpetuated these massive deficits in the United States, where the U.S. became dependent on the rest of the world. The U.S. needs the world to produce the goods that it can't and to loan it the money that it doesn't save. And, this was a big subsidy that the U.S. enjoyed, but it was a burden on the global economy. And I think the world is tired of shouldering that burden, especially since the world is being lectured by Donald Trump. And so, I think it's going to be a healthy development to move away from the U.S. dollar as the reserve currency. It's going to be very disruptive initially, but I think it's going to be a positive development for the world. In the long, long run, it will be positive for the U.S., but in the short run, it's a huge negative.
Right. And Peter, as the dollar relevance comes down, do you see any other currency that will likely take its place? Can the dollar get replaced?
No, there's not going to be a new currency to replace the dollar. I think the dollar is going to be replaced by gold. So I think gold is going to serve the role that the dollar had been serving as both a reserve asset for central banks and as settlement for bilateral trade. I think gold is going to play an increasingly important role in the global monetary system, the way it was prior to the U.S. dollar supplanting it.
This is the thesis statement. Gold, not yuan or euro or SDR, replaces the dollar. Why? Because all fiat currencies face same problem. Unlimited supply controlled by debt-laden governments incentivized to inflate. The yuan might be backed by production, but it's still printable. China could, and likely will, inflate to stimulate domestic consumption. Only gold's finite supply, can't print more, and apolitical nature, no government controls it, provide credibility. The way it was prior to U.S. dollar supplanting it references Bretton Woods era, 1944 to 1971, when dollar was gold convertible at $35. That convertibility made dollar trustworthy as reserve. When Nixon closed gold window 1971, dollar became pure fiat backed by trust us. Schiff predicts return not to dollar gold convertibility, but to direct gold reserves and settlement. Nations hold gold itself. Trade balances settled in gold transfers, no fiat intermediary. This mirrors pre-dye classical gold standard.
Right. Peter, another commodity which has been running, which has also seen massive highs, is silver. What is your view on silver, and how do you see this massive run-up coming in, given the fact that, many believe that there isn't much of a physical silver available in the market?
Yeah, silver prices obviously were too low for too long. Gold rose really from 2000 to 4000 without much of an increase in the silver price at all. Then silver finally caught up and probably got ahead of itself when it shot up to 121. It then pulled back below 70, and right now it's about $80 an ounce. I expect silver prices to trend higher from here, but it may take several months before we get back above the 120 level. But we're going to go above that level and ultimately much higher.
Schiff's $6,000 year-end target implies 20% plus gain from current $5,000 levels. Aggressive, but based on fundamentals: dollar weakness, debt monetization, central bank buying, reserve status loss. The specificity of January high taken out by Q2, likely referring to fifth $600 level, suggests near-term catalyst expected, either Fed QE announcement, major foreign treasury selling, or geopolitical crisis accelerating dollar flight. The how much higher caveat acknowledges potential for $7,000 if dollar collapse accelerates or war premium develops. Gold's resilience despite $500 Friday drop, mentioned in intro, demonstrates strong hands. Central banks and institutions don't panic sell on volatility. Compared to 1979 to 1980, when gold went from $200 to $850, 325% in 18 months. During dollar crisis and Iran hostage situation. Current setup, fiscal catastrophe plus reserve loss weaponization, arguably worse than 1979, suggesting $6,000 might be conservative.
Peter, how do you see the pricing outlook for gold and silver for 2026? And do you see both the commodities hitting a new high in this year?
Yeah, but gold got almost to 5,600 before pulling back. I think that it will end the year above 6,000. We'll see how much higher, but I'm very confident that the high that we set earlier in January will be taken out probably before the end of the second quarter.
And what about silver?
Yeah, I mean, silver is going to make a new high, but obviously it's further away from its high. It's 50%. It would need a 50% move to get back to its high. Gold only needs a 10% move, so much easier for gold. But, silver is very volatile, so it's hard to say. But I do believe that silver will make a new record high, maybe by the end of the Q2 or sometime in the third quarter of this year.
And Peter, I wonder how you look at U.S. Fed policy, given that you have a president who is pushing for lower interest rates at a time when inflation is likely to inch upwards directionally. What's the policy stance in your opinion?
Yeah, I think we have horrible fiscal policy in the United States and horrible monetary policy, which is going to get worse. So that's why gold is trading above 5,000. That's why the dollar, recently hit an all-time record low against the Swiss franc, and why it's continuing to fall now against a basket of other fiat currencies. It's because of the monetary and fiscal policy that we have been pursuing in the past and that we continue to recklessly pursue in the present.
And Peter, how do you see rising U.S. debt? Is that going to be sustainable for the U.S. going forward?
No, it's not sustainable. It hasn't been sustainable for a while. It's completely unsustainable. That's why people should be selling U.S. treasuries. That's why, China just advised banks to sell treasuries. I think Japan is going to be a major seller of treasuries. I think the whole world's going to be selling treasuries because the debt is unsustainable. It can't be repaid. It can't even be serviced. So it's going to be either default or inflation. And obviously, politically expedient choice is inflation. And that's the direction that we're headed. And it's pretty obvious. So our creditors want to get out. They don't want to watch the value of their U.S. dollar holdings inflated away. It's better to just sell now and move the money into something else.
The binary outcome, default or inflation, is mathematical certainty, not opinion. At 39 plus official debt plus 100 plus unfunded liabilities, even 5% interest costs 2 plus annually, nearly half federal revenue just for interest. As more debt matures and rolls at higher rates, interest costs compound. Default is political suicide. Social security stops, military unpaid, global financial system collapses. Therefore, inflation is certain. Fed will monetize, print money to buy treasuries, private sector won't buy, debasing currency to service debt in depreciated dollars. Creditors understanding this creates self-fulfilling prophecy. China, Japan, world selling treasuries forces yields higher, making debt even less serviceable, forcing more Fed monetization, accelerating inflation, validating creditors' decision to sell. The better to sell now. Urgency reflects recognition that early exits get better prices. When Treasury panic selling starts, bids disappear and losses magnify. Gold becomes rational destination for fleeing capital.
Right. And do you see interest rates going up, given that yield is still holding up above 4.2, and you have pressure coming in from many countries selling treasuries as well?
Yeah, I think there's going to be a lot of upward pressure on treasury yields from global selling amidst a glut of supply. We have record deficits that we need to fund. We also have a record amount of debt that matures over the course of the year, and the government needs to find new buyers for the maturing debt, and they're going to be scarce. So I think the Federal Reserve is going to be coming back with more quantitative easing to buy bonds that the private sector can't absorb and doesn't want, because the alternative would be a huge spike in interest rates, which the administration clearly it does not want because we can't afford it. So we're going to get massive inflation instead.
This segment describes the debt doom loop. 1. Record deficits require new treasury issuance. 2. Record maturing debt requires rolling over, refinancing at current rates. 3. Foreign buyers, China, Japan, are selling, not buying. 4. Private sector won't absorb the volume. 5. Yields spike as supply overwhelms demand. 6. Government can't afford spiking yields, interest costs explode. 7. Therefore, Fed must monetize through QE, buying treasuries with printed money. 8. Monetization causes inflation, more dollars chasing same goods. 9. Inflation validates creditors' exit, accelerating selling, requiring more QE, causing more inflation, death spiral. The massive inflation instead of rate spike acknowledges this is intentional policy choice, impoverish savers' creditors through inflation, rather than admit insolvency through default. Gold becomes only escape from this doom loop.
Right. Peter, but how do you look at the tariff war initiated by the US and the repercussions of it all?
Yeah, well, the weapon is aimed at Americans, and it's Americans who are going to bear the burden of these tariffs. Ultimately, their taxes on consumption in the U.S., they will raise the price of whatever we import and a lot of things that we don't import. I think it's more of a annoyance or a nuisance for emerging markets because it's disruptive to their, business. They now need to adjust to the U.S. being a smaller market. So countries are going to export fewer goods into the American market because of the higher prices. Americans will still buy foreign goods. They just won't buy as much because they're going to be more expensive. But in the meantime, businesses, companies in other countries need to reorient their sales channels. They have to find consumers in other countries who are not being targeted by tariffs, where their goods may be more affordable, and they need to look more towards domestic customers. And I think that will be a lot easier with the weakening dollar, because as the dollar goes down, then customers outside the US will now be wealthier and will be better positioned to buy the goods that Americans can no longer afford.
Tariffs are economic self-harm masquerading as tough trade policy. As consumption taxes, they raise prices for Americans, both on imported goods, direct tariff, and domestic goods. Less foreign competition allows domestic producers to raise prices. Emerging markets face temporary disruption, reorienting from U.S.-focused exports to domestic regional consumption, but weaker dollar accelerates this transition by making their consumers wealthier in purchasing power terms. The Americans can no longer afford outcome is ironic. Tariffs intended to protect American manufacturing instead make Americans poorer while foreign consumers get richer. This accelerates de-dollarization. If major exporters, China, Germany, Japan, Korea, sell less to U.S., they need fewer dollar reserves, can shift to gold local currency settlements. Tariffs thus achieve opposite of intended effect, weaken U.S. economically while pushing world away from dollar dependence.
Peter, you've been bearish on the Bitcoin, and we've seen Bitcoin, correcting in the last few months. Where do you see Bitcoin going in from here on? Do you see some kind of recovery on Bitcoin?
Yeah, I've always thought Bitcoin was more of a Ponzi scheme or pyramid than a legitimate, disruptive technology or an alternative to the US dollar or digital gold. I mean, I never bought into that hype. And I think last year pretty much exposed the fraud that Bitcoin is digital gold. Gold had its best year since 1979. And Bitcoin was down, and gold's having another great year, and Bitcoin's getting clobbered. So I think the air is coming out of the Bitcoin bubble, and that's going to, do more harm to the U.S. economy, because we've invested more in crypto than any other country. Americans are more exposed to Bitcoin and crypto than any other country. And
Bitcoin's collapse during gold's rally exposes the digital gold narrative as marketing fraud. Real gold, 2025, best year since 1979, up 60%. Diverging from Bitcoin, down significantly, proves they're uncorrelated. Bitcoin isn't gold's substitute. It's speculative tech asset correlated with risk appetite. When monetary crisis hits, what should drive both gold and digital gold, gold soars while Bitcoin collapses, because Bitcoin has no monetary history, no central bank demand, no industrial use, no intrinsic value. It's purely sentiment-driven. The Ponzi pyramid characterization: early buyers profit only if later buyers pay higher prices, no cash flows or productive use sustaining value. Americans' disproportionate crypto exposure means Bitcoin bubble popping causes greater wealth destruction in U.S. than elsewhere, another self-inflicted wound. Capital fleeing Bitcoin likely flows to gold, accelerating monetary metals' ascent.